Now today, originally the plan was to give you a speech about how we do our job. We called it Stock Market Success Secrets. But starting from about 2 weeks ago, I began to realize that although that speech would be interesting, it was not very appropriate for this particular time. Because now I think the stock market and the global economies have entered a very difficult, some people even say dangerous period. So I think it's more useful to spend the next 40 minutes talking about the investment outlook and a possible action plan for investors. It's more timely. In the short term, the outlook is okay, but short term means just the next maybe few weeks or before the year is over. Because the markets have already dropped so much, the markets look oversold, and there is a good scope for at least a short-term recovery. But unfortunately, September, the third quarter this year, you can see from the presentation, was really bad, especially for markets like Hong Kong and Europe. Hong Kong was down 21%. To people like me who've been following the market a long time, it suggests that the market is quite oversold, and even if the situation is very bad, markets don't go down in a straight line. As of the end of September, the valuation of the market was within 5 to 10% of the lows that we reached in 2008 financial crisis. So even if you think that the current crisis is as bad as 2008, which in fact is not, we are already very close to the low at that time. If you look at it another way of looking at whether stocks are cheap or expensive is to take an average of 7-year earnings. Don't look at any particular year because the business cycle is actually very volatile. And even in that way of looking at it, the market is really very cheap, going back even like 20 or 30 years. And if you look at the dividend yield minus the 10-year treasury note, this is a way of saying what is the return you get in cash from buying stocks. Again, the market looks extremely cheap. In other words, the cash return is very high. So the conclusion is that in the next few weeks or before the end of the year, I'm not too worried. I think there is a reason to expect just a rebound from the bottom, almost like a reflex action. What is really interesting now is we talk about the medium-term outlook because we are long-term investors. You know, the tactical fluctuation from one week to the next shouldn't concern us so much, especially since a lot of our clients or investors are looking at this more as a medium-term savings or even their retirement plan. I'll show you on the whiteboard what I'm thinking because you know, we manage a fund that is one of the biggest in Asia. We get a lot of information from a lot of experts. Every day, 7 days a week, we're getting a lot of advice and analysis. And I have worked very hard to prepare for this, talk to everybody, done my own analysis. Now, in summary, there are several types of recoveries. For most of us in this room, our age group, we are used to what we call V-shaped recovery. It looks like this. The market goes down and it goes up again very quickly. That has happened almost every time for the world, China, and Hong Kong for at least the last 20, 30 years. A V-shaped recovery is very nice. So that's why people always say when the market drops, you should buy immediately. In English, there's a saying, buy on dips. The problem is that this doesn't look very likely this time. This is the first time in 20 to 30 years that people like me, we don't think there's going to be a V-shaped recovery. That is the real problem we have. What is more likely this time, we think this is the most likely outcome, maybe 60% chance, is what we call a U-shaped recovery. And the problem is that this part of the U, the bottom of the U, may take several years. And the other problem is that almost everyone in the financial industry and the world have no experience of this kind of recovery because we are all used to V-shape. Later in this discussion, within the next half hour, we talk about an action plan to handle this sort of U-shaped recovery. Now, there's another possibility if you read the newspaper, which is basically no recovery. So I call this L-shape. Or even worse, down, down, down. This is collapse. We call that collapse. Unless you were born before 1945, no one in this room has experienced this. And because I enjoy reading history, I can tell you that when you have this kind of situation, the end result throughout hundreds of years of human history is either revolution or war. Okay, I'll go back to talking some details about this, but this is a summary of the investment outlook. Okay, so now it's easy to quickly go through this. We think there's a 60% chance, most likely case of U-shape, 20% chance of V-shape, and 20% chance of collapse. In summary, yeah? Why we think there's a high chance of U-shape, we'll now explain to you, but in a U-shaped recovery, it's not going to be an easy investment environment. It's going to be very volatile. And unfortunately, at the moment, for me, this is the most likely situation. Inflation in developing countries will remain high, but in the developed countries, I think you may have a chance of very slow or low inflation, or even some deflation. So it's a two-tier world. Interest rate remain low, you could have some social unrest, and definitely economic growth will be slow. But it doesn't mean we have a recession. I'll explain that to you later. And by the way, I don't know whether you can see the small print, but the emerging countries and developing countries, like Asian countries, South American countries, are in a much stronger position this time. This table shows you our reserves, which are very high. So this is not going to be a repeat of like the 1998 Asian financial crisis. The numbers look good for Asian developing countries. These are the latest estimates from IMF, dated September 2011, and they are still forecasting growth in the global economy. Not big growth, small growth, but it's not a recession. There is some chance of increasing social tension, social unrest. Looking at the world's most advanced country, the United States, in fact, if you adjust for inflation, average wages in America have not increased for 40 years. So there are a lot of unhappy people over there. Whenever you don't have a V-shaped recovery, social stability becomes a concern. So here you see, for example, in recent weeks, there is a protest movement in the United States against the financial industry, against Wall Street. These are some pictures. Yeah. And just very quickly to remind you, here in the developing countries, or like Asian countries, we still have some problems with inflation. That's why the Chinese government cannot really fight very hard this time. They are afraid that if they stimulate the economy again, inflation will go crazy. And also, we have another problem is that interest rates on bank deposits are negative. That means the deposit rate is below the inflation rate. In China now, deposit rate in a bank, the interest rate they pay you is 3.5%, but inflation is 6%. So when you save money, your purchasing power is eroded. So even this likely scenario, which is considered to be an okay scenario, is actually quite a lot of problems. And of course, here in Hong Kong, you go and put money in the bank, the interest rate they pay you is just above 0, but inflation is 5%. Just quickly to go to the medium, to the optimistic scenario, 20% chance where economies recover, inflation will then remain relatively high, interest rates rise moderately, we have social stability, and the investment environment is rather attractive. I think the strongest reason why we have a chance to achieve this, this is basically the V-shaped scenario, is that there is now a high chance that before the end of the year, the World Central Bank will launch a very big attack on all these problems. Some people call it QE3, some people call it something else. The Bank of England launched a 75 billion pound sterling program to stimulate the British economy. We'll see more and more of that. So I think if governments and central banks still have enough power, they will fight very hard for this scenario, for this V-shaped picture. By the way, just to inform you, if the central banks do this kind of thing, QE3 or whatever, my personal opinion is that it will only postpone our problems to the future. It's not a real solution. We now come to the pessimistic case. Remember I mentioned to you the collapse or the lack of recovery. We think there's a 20% chance, but it could really happen, so we should all be prepared. The crisis we are facing today is not really a financial crisis. It's actually a political and a social crisis. Part of the crisis is that the standard of living in the West is too high. I think Western living standards and incomes will have to decline or drop maybe 20–30% to achieve the equilibrium. But because the Western countries are democratic countries, the politicians need to get elected every 4 or 5 years. It's very hard for the leaders to tell the people that your standard of living is too high and it must come down. So in the worst case scenario, there are very few places for investors to hide. World trade will collapse. I'm sure they will blame China again for their problems. And you have bank failures. You have people stop believing in the paper currencies because they are printing too much paper currency. You have a crisis that is political, social, economic, and financial. This is not impossible to happen, but it has never happened for most of us, we've never seen it. It will be something like what happened in the 1930s. I think many of us in Hong Kong do not seem to be aware that the political system in the Western countries like US itself may be threatened. Some people even talk about many years from now a breakup of the US, the same way as we had a breakup of the Soviet Union. The social consensus is fragile. Look at this table. The opinion poll from Gallup opinion poll shows that 81% of the American public are dissatisfied with the way the US Congress is doing its job. Although we are here to talk about investing in stock market, the stock market share prices is very strongly affected by political forces. So this is actually quite important. Yeah.